Hi, my name is Claire Kim,
And I'm Melody Shue.
and we are pitching Vistra Corporation with a current $124 and a target price of $152.
Beginning with an overview of Vistra, the corporation was founded from the bankruptcy of Texas Competitive Electric Holdings in 2016 and is currently headquartered in Irving, Texas. The corporation generates and retails power to about 5 million clients across the U.S. and the District of Columbia. Vistra consists of many subsidiary companies for its operations, with the majority of their clients and source of revenue coming from Texas.
Moving on to the investment thesis or why we determined Vistra as a strong buy. First, they are a leading energy supplier, employing around 6,800 employees, and with the boom of AI and the need for more data center, there is an also increased need of energy, which we believe Vistra can supply. Additionally, Vistra is vertically integrated, meaning that they own 100% of the production of their energy to the distribution. They also have many different business segments, including nuclear energy, natural gas, coal, and other energy resources. They've also shown impressive recent growth, with their stock price growing 464% within the past 3 years. They also invest significant resources into renewable energy.
Vistra Corporation operates in the retail electricity and power generation industry. With about 41,000 megawatts of capacity, it's the largest competitive power generator corporation in the US. It also has about 7,800 megawatts of zero carbon energy and is expanding its renewable efforts continuously. The U.S. energy market is valued at about $1.23 trillion and is projected to grow 13.3% by 2025. Key growth drivers include the rising electricity demand, regulatory support, and the expansion of renewable energy, all areas of which Vistra is well positioned for.
You can see Vistra's 1 year growth here. Now for our moat analysis, and we characterize Vistra as a moderate to wide moat for three main reasons. First is their economies of scale. Vistra bulk produces their energy and has efficient distribution, lowering costs for their clients overall. There are also significant regulatory barriers in the American markets, reducing competitors. Vistra also has establishments in resources, policy knowledge, and energy contracts, making them a significant competitor. In the American energy market, there is also high capital intensity and infrastructure to become a competitor of Vistra, reducing competitors overall.
Vistra is strategically positioned in a highly competitive but rewarding energy market. From our Porter's Five Forces analysis, we've identified the most significant factors. First, there's a low threat of new entrants due to high capital costs, strict regulations, and long permitting timelines. This protects Vistra's established market share. However, industry rivalry is also high, especially with competitors rapidly expanding renewable energy efforts. Vistra stays ahead by offering both traditional and renewable energy sources, appealing to a wider range of customers. It also holds a major advantage as the largest competitive power generator in the US, giving it a scale and cost efficiency. Additionally, supplier power is moderate due to reliance on natural gas, but Vistra is reducing this by expanding solar and battery storage. Buyer power is also moderate, though long-term contracts that provide stability. And while substitute threats are high, Vistra is actively adapting by investing in clean energy, positioning itself as a leader in the industry's future. So recently, Vistra has had significant revenue growth. Their total assets grew by $2 billion from Q1 to Q4 in 2024, and their stock price reflected this with an over 200% growth. We've noticed a few main reasons for this. First is the increasing energy demand overall. AI data center growth and population growth contribute to this increasing demand for energy, and natural gas makes up the majority of Vistra's natural energy production. Next is acquisitions. Vistra is the parent corporation of 6 energy companies across the US, supporting its expansion. Notably, TXU is a child company of Vistra and is Texas's leading retail provider. From this, Vistra has two main sources of revenue: retail electricity and wholesale energy. In retail electricity, they provide electricity to homes, businesses, and energy grids. They also sell wholesale electricity to 6 out of 7 competitive markets in the US.
Now for our financial analysis, we analyzed a few key factors from the years 2020 to the year 2024. First, we noticed a 50.6 revenue increase from 2020 to 2024. In 2023, we saw an 83.7% increase in net profit. However, there was a significant drop-off across all factors in 2021 and 2022. This was due to Winter Storm Uri in Texas, which devastated Texas, which is where Vistra had the majority of its investments, leading to $1 billion in losses. However, we noticed a huge asset increase in 50%, about 50% in 5 years due to portfolio expansion. Additionally, in 2021 and 2022, we saw a cash flow decrease of $1 billion. More key points include that the ROE jumps from 7.7% in 2020 to 38.5% in 2024. The ROA also rebounded to 6.45% in 2024 following the previous decline. Also, we noticed a 209.8% earning per share growth in 2023, and throughout this time period, the debt to equity has increased significantly due to their infrastructure development. This graph shows the financial analysis and how there was a decline in 2021, but a rebounding in following years. For our valuation and how we calculated our target price of $152.93, we first used a price target calculation using the current price of $124 and a current PE of 18.65. We also used an EPS of 8.2 to calculate the forward PE being 15.17, and using these numbers, we calculated the price target to be $152.93. We also used a DCF model over 5 years with a terminal growth rate of 2% and an FCF growth rate of 3.5%. Then we used a discounting factor of 6.5%, and with these calculations, the model predicted that the intrinsic value per share would be $165.15. However, we decided to use the price target calculations due to sensitive material in the DCF model, and this represents a 23% upside. We also conducted a comparable companies analysis using 6 similar companies to Vistra, and we found that Vistra is undervalued despite having the highest revenue growth and outperforming competitors in terms of ROE and ROA.
Vistra faces 3 key investment risks. First, its revenue is vulnerable to market fluctuations. Changes in fossil fuel prices, weather, or consumer demand can directly impact profits, but its presence in both renewable and non-renewable markets help balance that risk. Second, Vistra faces strong competition from major utilities and renewable-only firms. However, its diverse energy mix and strong brand presence, especially in Texas, gives it a competitive edge. Finally, U.S. policy shifts could affect green energy incentives. Still, Vistra is well positioned to benefit from fossil fuel-friendly regulations due to its large conventional energy portfolio.
Now moving on to ESG considerations, Vistra has a 29.5 or medium risk rating, and they are looking to expand their sustainability in the future. For environmental, they're expanding clean energy through battery storage and nuclear power, hoping for net zero carbon emissions by 2050. For social, they are expanding their employee resource groups and are using 40 years to support their customers in need. They have also invested $2.4 million in nonprofit organizations per year. For corporate governance, they align their employee compensation with the company's ESG and DEI objectives and follow top reporting standards for transparency.
AI presents both opportunities and risks for Vistra. In February of 2025, Vistra stock dropped nearly 30% after the launch of DeepSeek, which is a low-energy AI tool, and this raised concerns that AI may require less power in the future. However, analysts believe that this initial scare will level out over time because if AI models are cheaper to produce and even more efficient, they will probably be more widely used, overall still raising energy amounts. Broader trends also point to the growing demand. Goldman Sachs projects a 95% increase in the U.S. AI data centers by 2026, and major tech firms are already signing large-scale energy deals. Internally, Vistra is also using AI as well, partnering with McKinsey to improve efficiency at its Martin Lake plant. The AI system led to a 2% efficiency boost, saving nearly $4.5 million annually and cutting 340,000 tons of carbon. It's now being used across 26 plants, showing the long-term value of AI integration.
From this, we concluded that Vistra is a buy for 2 main reasons. First, AI data center growth, and because of their diverse portfolio. Thank you so much.